Hello, everyone. Welcome to another Rocket Dollar webinar with Josh Plave of Wall to Main. You might have heard from me on the phone. We have some new people joining the Rocket Dollar sales team that'll be on the phone soon. But often I'm a voice talking to customers, whether they're looking for real estate in an IRA, alternative asset in an IRA, helping them through that process. Part of why we do these webinars. Some people already know exactly what they know when they want to invest in when they come to Rocket Dollar. Other people have sort of an idea. They're looking for an investment. And I guess the third category is people that, they might be into crypto, they might be into startups, they're having fun with the Rocket Dollar IRA, but they really say, hey, I'm exploring some real estate, I'm exploring another asset class, but I really don't know anything about it. So we do this to keep the customers really engaged, and also welcome if you're not a Rocket Dollar customer yet. Have some education opportunities from some experts in the field. So I do our business operations here and our sales here. So Josh, I'd love if you'd introduce yourself.
Yeah, absolutely. Hey, everyone. My name is Josh Plave. I run Wall to Main. We're a multifamily syndication company specializing essentially in helping folks use their retirement accounts to invest in multifamily. I myself kind of got started using IRAs. I came at things as a passive investor to start with, and ended up moving to the active side of things. And now we just actively scour the Midwest and Southeast for properties that work best for IRAs, 401ks, things of that nature.
Great. And the reason real estate has always been one of our top 3 asset classes every single month. If you just do a straw poll or you actually look at what people are investing in, it's just a very popular asset class. Some of our customers are really hardcore tinkerers, like to go for an individual property. Just know you can do that, but there's a lot of rules there. A lot of customers look at multifamily deals, but the one problem people run into is with multifamily, often you need to join up with other investors. Some customers of ours have that great luxury. They know 5, 6, 10, 15, 20 people that are going in on a nice deal. Other people struggle, say, I'd love to do a deal in this town. I'd love to go into an apartment building. I just don't have the capital to buy it myself. So Josh has a lot of expertise here, and I really wanted to bring a current topic, which is, how we've had a lot of rent disruption. We've had rent dip quite a bit, and we've had rents come back up. Just talk to anyone on the street, call some of your relatives. This is really, I think, a market force people can feel in their days in their lives, talking to their family, moving around the country. And so some investors obviously are very interested in the investment side. Maybe it's disrupting real estate investing that you are currently doing right now. So Josh, without further ado, we'd love to dig into some of the great numbers and data that we've seen today.
Yeah, absolutely. Let me just share my screen. Brendan, if you could just turn that on for me.
Yeah, I'm gonna throw you host,
Okay.
and then you'll do that. Just give me a second, and we're gonna do a quick multifamily 101, and that's because we always have some really experienced customers and prospects join on our webinars, and sometimes we have people that are encountering multifamily for the first time.
Alrighty, so let's get started here. So yeah, already introduced myself, Wall to Main. My name is Josh Plave. So that quick primer on multifamily, and why we think it's a powerful tool to kind of take your retirement to the next level. So let's just take a first look at kind of the types of assets that we typically invest in, what kind of shape it's in. Commercial real estate is split into 4 categories. Those are A, B, C, and D. A is going to be your brand new high-end amenities, type of property built in the last 10 years. If you take a look at the background, this is a nice Class A property that we own and operate in Sarasota, Florida. But D, on the other hand, is kind of going to be on the other side of the spectrum. It's high crime, high turnover, low paying tenants, really in the worst area of town. So, we like to primarily look at what you would call like a C+ property and above. That's going to be your everyday workforce housing that, somebody always is in need of renting. The ideal apartment complex is typically going to lack amenities, which we can add in and sort of see the benefit from. It'll have deferred maintenance, and there's likely some leaky pipes around the property. Maybe the apartment units themselves are in rough shape because they're not being looked after between tenants. And most importantly, rent is currently below market on these properties because current management just hasn't been paying attention to what the market will bear. More often than not, we've found that these properties exist within the Sun Belt. So that's something we'll be covering a good bit today. But as I touched on, the type of opportunities that we look for are what's called value add, where we can force the property's appreciation by improving conditions with the money we invest and benefit from a more efficiently run apartment complex with a higher valuation at the end. So there's really two sides to the coin of how you can do this. We look for ways to increase income, whether it's through rent increases, charging for covered parking spots, rent bill back, or sorry, utility bill back, things of that nature. And on the other hand, we can benefit just the same by reducing expenses. Something as simple as installing low flow toilets and shower heads can really have a huge impact on the property, which we'll talk a bit about in a second here. But the way that a property's value is derived ultimately is by dividing the net operating income, or NOI, by the local cap rate, which is essentially just the expected return for an asset if you were to buy it in all cash. But as we all know, we've been in a low interest rate environment lately. So cap rates have been compressing in response. Because the cap rate is the divisor in this equation, the lower the cap rate goes, the higher the valuation. So, let's look at this like in real terms. That means that for every dollar that NOI increases, whether that's an increase in income or a decrease in expenses, if the current cap rate is 5%, that will result in a $20 increase in the property's value. Now, to take it a step further, if you remember, I kind of just mentioned that one of the best ways to bump up NOI is to just bring in more efficient appliances, cut down on your utility bill, drop your expenses. So let's say we bring in some low flow toilets and shower heads, as we mentioned, we decrease that water bill by $5 a month in every unit of a 100 door property. Well, you're going to see that, across the complex for an entire year, and it's going to result in a $120,000 increase from just a small $5 change. And that's really kind of the core of why multifamily investing is so powerful. So, the question is, how do we get this done? These properties tend to cost between $10 and $40 million or more. I don't know anybody who really has enough to put a down payment on a property of that size. So the way to secure something of that size is what's called a syndication. So simply put, a syndication is group investing. We'll typically have at least 20 investors who as a group put together enough equity for a down payment, the rehab and capital reserves. And there are two roles in a syndication. There are the general partners, or GPs, and the limited partners, or the LPs. When investing with a retirement account, you would always be a limited partner, an LP. As a limited partner, your participation is purely passive. You supply the upfront capital to help acquire and operate the property. The general partners do all of the work for you, and for the other investors, providing you with monthly updates of the current progress on site, as well as quarterly distribution checks. And that's kind of the piece that I love myself whenever I'm a passive investor. You get the benefit from your pro rata share of anything that goes on at the property. That could mean monthly rental collections, nice paper losses that would occur to help offset future capital gains. Really anything that flows through the property ends up flowing through to you, the investor.
And something to add on to that, Josh, is I see a lot of customers, they're kind of overwhelmed with the complexity of an IRA. They're excited about all the opportunity, but they don't know how to harness it. Being a passive investor is a great first step or first dip into self-directed IRA investing, because you're getting all that benefits of a nice diversified real estate investment, but you're not getting into all of the rules about IRAs and real estate. And just to keep it super simple, it's if you own a single property, you really can't work much at all on the property. You can't physically work on it. You have to be pretty hands-off, act like the boss. So being a GP or being a single family owner property can be difficult. It's not every investor is ready for that. Jumping in as a passive investor in a place or a market that you really want to get into, sometimes a much simpler option.
Yeah, absolutely. You can take advantage of the same, market metrics, demographic shifts and everything without really having to find the property yourself and pinpoint exactly where you think is going to be the prime opportunity.
And there's a little bit of that diversification too, of when you have a lot of other investors with skin in the game. There's a lot of tenants in a multifamily property, whereas a single family home property, you've got one tenant. You got to be good at finding them. You better have good tenants. And having those other investors to assist you as a passive investor, basically, they're driving the bus for you. You get to sit along and ride in the back and reap some of those benefits.
Yeah, that's my favorite part. I mean, if you own a single family home and you have one tenant that leaves, that's 100% vacancy. If you do that on 100 unit property, that's 1%. So not as much of an impact on a person by person basis. There's not as much of a reliance on your ultimate success. But anyways, the shifts that we're going to talk about today kind of all come down to two things. It's really housing supply and demographic factors. So let's take a look at what's kind of moving each of these markets. And then at the end, I'm going to uncover what the hottest markets have been over the last year. So when we're talking about where to invest in multifamily, it all comes back down to home prices, really. As we all know, I mean, they've been taken off in the last year or two. Nationally, home prices are up 40% since the beginning of 2019, really taking off since June specifically of last year. For this presentation, I kind of want to take a look at the largest markets in each of the 4 states, that we'll be talking about today. So for Arizona, there are really 2 big markets, and both of those exceeded the national average, growth rate over this time span. Something I was really surprised to see in Texas, just Rockefeller's hometown of Austin, did better than the national average. I'm sure you've, seen something along those lines, Brandon.
Yeah, so I was just trying to buy a house, and luckily there's been a slight lull, but only because a lot of people moving here already put their kids in school. So a lot of parents just got down to the wire and said, we need our kids in school by August, the late August or early September. And so they are out of the market right now. But skyrocketing prices in Austin, the house I live in, one of friend's house in the back here, that price is about double from when I moved here. So crazy growth in the center of Austin and also in the suburbs right around. So I decided, hey, I'm going to grab something in the suburb before those suburbs become unaffordable as well.
Yeah, absolutely. We're seeing it in a lot of cities, and you'll see it later on. But I used to live in Denver until last year, and it was pushing everything not just to the suburbs, but other cities like Colorado Springs, and they were benefiting even more than Denver itself. So, anyways, in Florida, it was 6 of the 10 largest cities, and in North Carolina, it was the entire state. It was 9 of the 10 largest that were outdoing the national average.
Wow.
Now, why does this really matter? Well, as we know, the rising cost of single family homes are pricing out many first-time homeowners. They're unable to buy. They're remaining in what we call the renter by necessity group. If we take a look at where these home prices have taken rents, we can see that they move together in near lockstep, with rents kind of following a very similar growth curve. But we don't really expect this to slow down too much. Because there is a growing house shortage. In 2018, we saw that there were already 2.5 million single family homes short of what is needed to meet demand. But I mean, by 2020, that had already grown to 3.8 million. As over 70 million millennials who are looking to buy are now coming online. They're looking to buy a home and they're trying to move in, but there's just nothing available to them. And these numbers are from Freddie Mac, and they already went on record and said they don't expect the shortage to slow down in the next 10 years. The story doesn't even end there. So one of the bigger issues that we're seeing now is that new build development is targeting larger and larger homes, more expensive homes at that. As the price to build has risen, and we've all seen it, developers are no longer targeting smaller starter homes, but they're building out larger luxury accommodations. The vast majority, on the other hand, of multifamilies rental stock is around 1,400 square feet or less. So with the production headed in the exact opposite direction from what's needed to meet the growing demand, this really only further increases the number of people that are stuck in that renter by necessity category. So, what kind of effect is this having overall? Well, because of the high barrier to entry, when a single family home is sold these days, it's more often than not being occupied by the owner. I mean, this has had an effect of reducing the supply of single family homes available to rent. You know, and as more millennials move into the buyer pool, they find themselves less and less able to meet these growing prices. And this just means that there are more and more prospective buyers who are remaining in that renter by necessity category, and it's causing you know, huge surges in rental demand. With these huge forces pushing down supply and creating, you know, high rental demand, single family rents are up an incredible 14.3% year over year, pushing many renters towards multifamily properties. But in the past 2 years, as they've gotten to those properties, they've been met with properties that are under eviction moratoriums. Now, I do want to, you know, mention one thing. You know, it was not a ban on evictions altogether. We were still able to evict for any reason beyond non-payment. So we haven't really seen complete detrimental effects at our properties, but it has resulted in some incredible consequences on a local market level. This is a little case study I put together for a recent property that we purchased in Bradenton, Florida. These were the 8 properties within a 3-mile circle of our purchase named Bradenton Reserve. We went and toured these properties, and what we found was that, you know, nearly every single one we walked into, they were 99% occupied, or they were completely full. Because these owners were restricted from evicting, you know, non-paying tenants, the vacancy levels had essentially artificially inflated, meaning that even though there were over 2,000 units that existed in that small, you know, area, only 20 were available to rent, and the demand for, you know, units that it's hundreds every single week. We see so much traction in this area, and, you know, more and more people are migrating south, and they're moving into markets like this. And even with the moratorium that's ending, you know, we're expecting to see the level of occupancy to kind of remain very high for some time before stabilizing back down to normal levels. This is, you know, it ends up resulting in exploding rent growth in, you know, desirable markets like this one. Occupancy nationally is actually at 95.9%, which is the highest it has ever been. So, I mean, as I mentioned, we're seeing incredible migration headed south, which is resulting in, you know, shifting demographics across the Sun Belt. One effect I've loved looking at is baby boomers are retiring to towns where their children have established new roots, are having babies of their own, and building new families. So a research firm named Zonda actually took notice of this and found that 25% of baby boomers ultimately plan to retire near their grandchildren. So they put together what's called the Baby Chaser Index. They update it every single year. And it's a study that essentially just looks at the migration patterns of baby boomers and where they are headed to live near their grandchildren. You know, I think it's fairly accurate. Just last year, my wife and I moved from number 9 to number 1, and we were looking at number 5 along the way, actually, while we were getting ready to have our daughter, who was born in April. We did it essentially to move to our family, but the power of families moving to, you know, towards one another, especially when millennials are now moving into desirable cities in the Southeast and the general South, is undeniable. So yeah, heavy concentration in the Southeast. As you can see, our favorite 4 states have a heavy presence here that we're talking about today. They take up the top 5, as well as 7 of the top 8. So, you know, but
Yeah,
enough of this kind of, yeah, sorry.
I moved from Chicago to Austin about 3 years ago, and you know, I think there was a little bit of revolution of people that were just in these Midwest and colder states. Hey, I need to be here for a job. When strong jobs started showing up in all these secondary and third cities, all of a sudden those cities became much more attractive. Hey, you don't need to be in Chicago to be working at a Fortune 500 job. Now that we're kind of hitting a work from home revolution, a second thought comes in people's mind. If I can kind of work anywhere and they'll kind of let me live anywhere, why don't I live somewhere with better weather? So people are now equating that a couple bit more mobility, whether it's job or it's work from home. That strength has increased in the Southeast, and also the weather thought just cannot be denied. Yeah,
absolutely. It's very true. But more than really any of these metrics, what we really use to determine, you know, our prime investing opportunities are job growth and unemployment. So let's take a look at how things look for these 4 states that we're talking about. So we're going to look at job growth over the past year for just the biggest markets in each of these states. In Arizona, it was a strong 2.73%. Texas was right in line with the national average. Florida came in at a huge 0.23%, but I'm honestly hesitant to kind of lend too much credence to that number. As the previous August was it was really hard in the state. So it's a bit of an outlier to base the year over year stat off of, but
Could be
either
like
way, it really
Disneyland,
points to a very strong
cruises.
rebound.
Cruises and Disneyland and tourism and stuff like that, because that's had a big rubber band back and forth to recovery.
Yeah, absolutely. If you've been looking at vacations, it's clearly been the place to go for a while. So they've seen quite a rebound as a result. But finally, we've got North Carolina with a solid 2.6%. So last, we'll take a look at unemployment rates. Arizona is above the national average of 5.2, and Texas is right in line with it. Florida, on the other hand, is a 0.5% below at 4.73. And North Carolina is incredibly strong with nearly a quarter less unemployment than the national average. And really here is where I wanted to illustrate, the current strength of Florida and North Carolina, which kind of leads us perfectly into our, what the hottest markets are right now. So, let's take a look at what all of this culminates into, what all these shifts are doing, and how much rent has grown in certain markets. Nationally, multifamily rents have climbed 11.4% from September of last year. And this number is actually a very strong one because there was virtually no dip in asking rents through the pandemic. So we're seeing strong data point to base this off of from last September. But those numbers, they grow even more when you take a look at the hot spots of the country, more urban areas across the Sun Belt. So when looking at the top 10 large metros across the country, growth it's just been astounding, ranging from 15% all the way up to nearly 23%. We especially see, the 2 standouts at the top with Phoenix and Tampa far ahead of that rest of the pack. In these markets, the rents are up, which is driving income and ultimately property values. These are big markets that already commanded top dollar. And so this is really helping to move and accelerate things even further along. But if you're a visual learner like me and you want to see these mapped out, we can see that, all the top metros are right in the Sun Belt as more and more people are moving to southern warmer climates. But ultimately, we can't really just look at these big towns. More often than not, and it's true, more often than not, the best opportunities lie in secondary markets. So let's see the results for secondary ones. Our absolute favorite market, one where we've acquired 2 properties already this year, and we think we might have another one available to investors in the coming months, is the Southwest Florida coast market, which is seeing an incredible boom. As you can see, its rent growth is 4.5% above any other market in the country. And we've seen that play out in reality, honestly. Rents really are up that much on our property. And it's even more for units that we've actually gone in and renovated themselves. So it's staggering to see the amount of demand that's occurring there. But aside from that, though, it's much the same with secondary markets. They range from the mid-teens and up. So when we take that original map of the big cities and then we go ahead and add in the secondary markets, we still see much of the same pattern. 16 of the top 20 markets reside within that Sun Belt still. But here's really where I'd like to point something out, and ultimately why I wanted to have this conversation. It's why I believe North Carolina and Florida to be the strongest markets currently. Because of the home price growth and the unemployment and job growth numbers we've seen, North Carolina has 3 markets that are in the top 20. Florida has 4. No other state has more than 2. And I mean, this is the strength that we're seeing in these markets. The growth of the southeast corner of the country is just, it's incredibly strong. When choosing to invest and look for new opportunities in the states, these states were, seeing multiple cities where we're finding opportunities. We're looking at properties in this area that, more often than not, the fundamentals are just bolstered by these strong local demographics and upward trends that we've been talking about. And it's promoting some really strong prospects for the region's future growth. So it's spread out across these states. It's not just isolated to 1 or 2 cities, which is kind of what I want to mention. But this is essentially why we continue to look for properties across primarily the North Carolina, Georgia, and Florida area. And these are a few properties that we do own and manage for our investors all across the Southeast. We're constantly vetting and looking at new properties and acquisitions, looking for opportunities that are perfectly aligned for retirement accounts. What I mean by that are investments that, these are investments that plan to return large portions of your originally invested capital back to you in the first few years so that you can keep the velocity of capital up and bring multiple streams of cash flow into your retirement account ultimately. And most importantly, we look at the UBIT impact of every single property that we consider. And I just wanted to quickly run over kind of why it's critical when choosing the right investments for your self-directed IRA to look at UBIT. So, if you plan to invest in multifamily with your self-directed IRA, there are two main concepts you should know. So let's say we bought this apartment building with a 25% down payment up top and have leveraged the remaining 75% from an outside lender. The portion in light blue is owned directly by your IRA, and any income that the property generates from this portion of capital remains completely tax-free. But the portion in dark blue was funded by non-tax deferred dollars from an outside lender. So your IRA is benefiting from the use of non-IRA money, and it earns what is called unrelated debt financed income, or UDFI. So IRS is totally okay with this. They just say you need to pay taxes on it. Those taxes are called unrelated business income tax, or UBIT. But luckily, though, this portion of capital can use its share of depreciation, operating, and income expenses, really any kind of loss that occurs to help offset that UBIT impact. So if this concept is new to you, you're probably concerned with the idea of paying taxes in your IRA. I know I was, and wondering kind of how detrimental that can be to your returns. So this was, as I mentioned, the same problem I had myself when I started investing in multifamily. And in order to figure out that answer, I actually built the real estate industry's first, and I think still only, UBIT calculator. It's something that we use at Wall to Main every single deal to help evaluate the overall impact and to find properties that minimize the effect for our investors. What we found is that on most multifamily syndications, UBIT has effectively no impact on cash flow. There are enough losses that you can carry forward to help offset the majority of rental income. And the main effect is seen really at the time of a capital event. That's typically when a property sells. But in analyzing hundreds of deals, what we found is that UBIT will typically result in a 4% reduction to your average annual returns, with a 2.5% reduction to IRR. However, in our hunt to find properties for our investors that minimize this impact, we've historically offered opportunities with just a 3% reduction in annual return, removing about a quarter of the total tax obligation for our investors. And the overall IRR impact of our offerings has been 1.9%, allowing your IRA to really move into more investments over time. And finally, if you're new to investing in multifamily with your retirement account, or you'd really just like to find some ways to make the most of what you have, I'd love to share a free PDF with you that uncovers the top 10 tips and tricks when investing in multifamily with your retirement account. If you just text the phrase top 10 to the number 66866, and you follow the prompts, we'll send it straight to your inbox.
Yeah,
that's all I've got for you today.
Thank you, Josh. Feel free, customers, we have some customers and prospective customers here. If you're just stopping by, if you have any questions, please feel free to throw them in the chat right now. I have a few slides, but I want to stop for see if there's any real estate focused questions. I'm going to jump into a quick IRA real estate, just a few minutes. And as we wait for some questions, I just want to say when I talk to a lot of real estate people, they're excited about working with real estate investors, but I ask them, hey, have you prepared your investors or for Rock Dollar customers, have you prepared that with the UBIT impacts? That's just one knock I can give to the rest of the industry out there. It's a complex topic. Josh is always prepared for this, and he always knows the impact before any investors going in there. So I like that he's ahead of the game on that, because oftentimes someone's excited about a real estate investment. They're super ready to go. They bring their IRA and they're all ready to close. And then they find out that there's UBIT involved. And all of a sudden it's like, you threw a wrench into your bicycle chain. You get thrown off. You're frustrated then, and you're all confused. All right. So this is kind of a non-IRA question because you cannot do 1031s inside of an IRA, but very popular topic. So Josh, someone asked, does your firm do 1031 exchanges?
Yeah, absolutely. We employ if you have a 1031, you're probably familiar with it, a tenant in common, a TIC. And typically the minimum capital gain that you're deferring has to be somewhere in the range of 400 to 500,000, which is what we've heard is a lot less than most syndicators. So we're always happy to work with 1031 exchanges and do so frequently.
So someone asked, any update in the possible restrictions for investing in real estate within an IRA? So thank you, Ross. So that might be referring to the current legislation on Capitol Hill. Josh and I actually had a long private conversation about it. So my current opinion is that while the bill is not passed yet and things are pretty messy in Washington at the moment, there has been a lot of discord and it hasn't been exactly a united front. So there has to be 50 senators to pass what's called the reconciliation bill. So there were two bills on the Hill, and there was kind of this compromise between the moderate and the Republican wing. They wanted a bill to vote on together. Then the progressive Democrats said, okay, we'll give you that, but we want our reconciliation bill. And this is where we're going to put all of our progressive policy. This is where we need less votes to get it done, so they can get it done with 50. However, you might have heard their names. There's someone called Joe Manchin and Kristen Sinema. I'm not going to go into anything more, but they're not on the same page yet with the progressive Democrats. So we've seen some talk about that bill being massively shrunk down, massively changing. And the reason why this is important is there were some commentary about IRAs, probably in response to Peter Thiel. You've heard Peter Thiel uses something similar to a Rocket Dollar account and had explosively high Roth gains. So Rocket Dollar has been out there talking to through certain channels. There's a bunch of self-directed IRA providers that are talking to Washington and say, look, obviously Peter Thiel is a huge billionaire, but there's a lot of people with IRAs that make much less than $400,000, which seems to be the level that they're trying to really target, that invest in real estate and IRAs. So we've been trying to communicate with political channels and also with our competitors, basically getting together and saying, hey, let's talk about what people are doing with real estate, because we don't want everyone to have to push to just Wall Street stocks again. A lot of investors, a lot of our customers, a lot of our customers make $80,000, $100,000, $70,000. They're starting an IRA with us. Some obviously makes more, but there's a lot of people that find real estate really value to invest in their IRA. So we've been talking to Washington a little bit through those proper channels and saying, hey, can we give you a call? Can the group of self-directed IRA providers communicate that a lot of people love investing in alternatives through their IRAs? Please soften the rules or change them so they're a little bit more targeted to actually target people that make 400,000 above. Don't suddenly knock out everyone from investing in a real estate syndication that could really benefit from that investment in their retirement account. Okay. Does anyone at Rocket Dollar put together investors for the projects? So right now, Rocket Dollar is very disconnected from investments. So if you want to go talk with Josh, you can go talk with Josh and obviously have a conversation if you would like to ask him about some investment opportunities. But for right now, we stay pretty far back from that. We're going to have some exciting developments coming over the next year. I wouldn't say we'll be putting together deals of investors, but we will be getting more into that game. Can't really share much about that, but those are some exciting developments probably coming in Q1, where there'll be a little bit more exciting stuff that Rocket Dollar is pointing to or saying, hey, this is an investment you could possibly do. Eric had a previous question. We'll try and get to that a little later. Okay. Yeah, so someone asked earlier how easy it's to open a self-directed IRA and transfer it to put in real estate. Typically, that takes 3 weeks for us, 2 weeks with our premium account. We hope to be launching a even simpler IRA that's hopefully going to be coming out October 25th. I had a few slides, but I'm going to want to get through everyone's questions first. that's going to hopefully put that time to be even faster. It's a faster IRA. It won't have an LLC in it, but it will be able to open very quickly. We have an LLC IRA. It's a little complex. It's for the tinkerers that love that. And that can go into almost any real estate deal. So you need to take some time to set it up, but once it's done, you can fire off. If Josh says, I got a deal closing tomorrow, if you don't get money by tomorrow, you're not in. With that account, you could even send money same day or next day to make a very down to the wire investment. And our support team will help you through the entire opening process. It's part of, we want to make it easier to invest in alts. Do you typically help to create an LLC for each property purchase? There are two separate ones for the down tax payment monies and one for the UBIT portion. So Eric, when we make an IRA LLC for customers, Rocket Dollar always makes a Colorado LLC for that person. So if someone wants the IRA with an LLC in it, we will make that for them. If there's anything after that, sometimes our customers are making that, or Josh, in your syndication structure, if let's say you're doing a multifamily investment syndication, would you have an LLC structure that customers would then send money to?
Yeah, so we ultimately have an operating LLC that everyone pulls their money into. But yeah, you just have the one entity that you would invest into the syndication with. Mm-hmm. And then at the end of the year, we send out a K1, and the K1 specifically is for an IRA, which will then spell out which of the losses are allowable and can be used to file what's called a 990T.
Great. Yeah. And so basically, if you're going into one of Josh's multifamily investments, he's got the LLC covered. If you're looking for a Rocket Dollar IRA, with or without an LLC, we will cover that for you. We will make the entire structure for you. So the only time someone would need an LLC for every property, that's often our single family investors. So when we do like single family investor education, a lot of our single family customers that want a single family property, they will go out and tinker and open an LLC in their home state. For a multifamily investment, that's really not needed. Either Rocket Dollar or Josh will have you covered on that. Can you send a recording link to the webinar? Check our YouTube channel about 1 hour from now. I always try and upload these as quickly as possible as soon as it processes on my computer. Does Kirk Cadwell ask, does anyone at Rocket Dollar handle the tax filings related to UBIT? So as I've said before, what I love is that Josh really helps people prepare for the basics of UBIT, what they're going to be dealing with. But Josh is not a CPA. Rocket Dollar is not a CPA. So I love that Josh helps investors prepare. He offers a lot more help than some others do. But a licensed CPA will be important for that 990T form, right, Josh? And we have someone we can send. Rocket Dollar has an outside CPA that we trust that can assist you with the 990T form. So Josh, when someone says, hey, I really need to file this 990T form, Josh, what do you tell that investor?
Yeah, I tell them you have to have a CPA who specifically understands the structures of a self-directed IRA. Not many know what self-directed IRAs are or how real estate fits within. Mm-hmm. So having one that kind of specializes in real estate, those tend to, if you already have one, they might have an idea of how it works. But yeah, it kind of is key at the end of the day.
Yeah, and so this is something, if you present it to your CPA and they know it backwards and forwards, great. But if your CPA expresses doubt or they're a little hesitant, they're like, this is really not my area, don't try and force a 990T on that. Please come to Rocket Dollar. You can ask for a recommendation. And we specifically, that's why we worked with a CPA like this, is they need to understand these issues. And if it's a tax form that your CPA doesn't fire normally, they'll probably tell you, but you do not want them winging it. CPAs never want to do that. CPAs will usually be very vocal and always say, hey, not my area. I can help in these areas, but please go somewhere else. And the same shoe on the other foot, Nathan, our CPA that helps a lot of people, he can do people's personal taxes, but it might be like bringing in a little too much firepower for him to just do a standard tax return for you. It's great to approach him for to do the 990T. All right, sorry guys, I'm trying to get through all the chat and questions here. All right, I'm going to go back to the Q&A for a second. If you invest in a syndicated multifamily deal, can UBIT be offset by depreciation from a leveraged position? Josh, that's for you.
Yeah, absolutely. So if let's say you've got 75% leverage on the property and you have $1 million of leverage, you can use $750,000 of the depreciation. You never can use the depreciation from the IRA side of things, but the outside dollars can always make use of that and then offset UBIT from there.
Okay, and again, another pro for multifamily investing is you're a single family home investor and you get a loan and get financing. Some people are prepared for this, but you have to find those write-offs, which is doing the property is one thing, working with a CPA to specifically find all those write-offs. So even though Josh won't, he can't file your 990T for you, he at least can help you with the write-off, some of the expenses and write-offs of it, correct?
Yeah, absolutely. And getting into a leveraged investment is a lot easier through multifamily because you have to find local non-recourse loans. If you're going to be purchasing single family properties on leverage, it has to be non-recourse, and not every bank has that.
Yeah, so we often have to send people to our partner bank, Solera. People are free to go to other banks if they're if they're not using Josh, if they're going for their own single family, but a lot of banks just don't understand non-recourse, or it's not their main business model. So even if they do get it, it's just not a risk that they want to take. So always make sure, same thing like the CPA, make sure you're going to a bank that understands it. You cannot use a traditional mortgage to purchase a property in a self-directed IRA. What deals does Josh have open for subscription? The email asks. So that would be on your website or following up with you, Josh, correct?
Yeah, due to SEC regulations, I would not be able to mention those to the public. So if you'd like to reach out to me, we have a contact us form, an investor form. Yeah, you can follow up with me in a number of ways.
Okay. Yeah. And just know the audience compliance wise, there's always really strict regulations on that. So just follow Josh's process, work with him on that. If you don't follow it, he can't open it up to you. If you follow it, then he can talk to you further. All right. So someone said I just did a deal through my RD LLC earlier today. It was seriously that fast. And yes, that's what we've hoped is the LLC account. It takes some time to set up, but once it is done, you can, as I used to say, you can shoot from the hip. If there's an investment opportunity for you, you can get into that in 24, 48 hours. And especially in this real estate market, sometimes that pressure does come up pretty often. Someone asked, does Rocket Dollar file the 990T? We do not, but we have an outside CPA that can assist you with that. He'll usually do a free consultation, just to, 15, 20 minutes to get to know you, see what kind of deal you're working with. After that, he would be a charge to, I'm sure he has a very standardized price for filing 990Ts because that's a very typical work for him. Is 99T required for a syndicated multifamily deal? So Josh, that depends on the financing, correct?
Yeah, it would. I'm currently in this situation where we didn't have any income for the year, or it was mostly losses. The losses offset, but we are still filing 990Ts to carry forward those losses.
Okay. All right. Yeah. So it depends. It depends on what's going on in the multifamily deal. The biggest things being the financing and probably the profits, is the revenue of the investment. Okay.
Yeah.
All right. And then I've cleared out Q&A. I'm going back to chat. Is there a way to structure it to avoid the K1 at tax time? So the K1 in the IRA is pretty much just informational at this point. So you still kind of want a K1 just so you have it for records. The biggest things to showcase at tax time is actually when you enter the investment with Josh or another syndicator or something like that, is you need to be very clear that your Rocket Dollar IRA name is on the paperwork. Rocket Dollar, that was kind of my slides. We're going pretty long here today, but we're getting it in more into that IRA that has no LLC, and we'll provide the titling of how to put that on Josh's paperwork. But a lot of our customers love us for the LLC IRA. And that one, you need to make sure the LLC is presented on the paperwork and also fill out the W-9 correctly. So we have the W-9, how to fill it out on our website. That W-9 is really how you're signaling to the IRS, if they ever look at this, hey, this is probably in an IRA. I see that this is non-taxable because I've checked the box that is a non-taxable disregarded entity. So the W-9 is really your most important form. And that just makes a couple other things that are related to taxes that people see often. It makes a couple of those other pieces just informational only. So it's still good to get, file it away, and then you can actually use it for your end of year valuations for the fair market value for your IRA. What that is Fidelity and TD Ameritrade know exactly what your stocks are, but since we deal with so many different investments, we're just going to need, Josh and you to work together, give us a quick value. You can type it out in our investment tracker. Once we have that number, then we can report to the IRS the value of your IRA. It says nothing about multifamily investing, simply says, hey, the IRA has a value of $75,000. Do I need a separate tax ID for an IRA, multifamily investment, or social security number? So you really want to use the EIN. You want to use the EIN tax number of the Colorado LLC. And then we also have the EIN number of our IRA custodian. What our custodian has told us is if your investment's paying no taxes, like no UBIT, it's fine to use the IRA custodian's EIN, because what's that telling the IRS? Oh, this is probably an IRA. This probably pays no taxes. What our custodian has told us is if you expect UBIT, which is often with an investment like this, if you're in an IRA, you should use the Colorado LLC EIN. And we'll provide that when you get that at sign up. So someone asked why we use Colorado. This is a common question of ours. Why do we use a Colorado LLC? Colorado looked at Delaware and said, hey, you got a lot of great LLC law. Everyone loves this. A lot of their legislature said, why don't we just, they've done the work. Let's just copy paste a lot of this back into our law. They're a very fast and responsive state department, and they're also very tech enabled. So if 100 customers sign up in a day, we can get you covered. We can open up the LLC quickly. We can work with our partners to get all that open. And it's a cheap LLC. It's very affordable. So we include the fees for the Rocket Dollar account. We cover the LLC. So we use Colorado because it's quick, easy, and efficient, and it's a very business-friendly state. And a lot of customers will sometimes add a local LLC they love below ours. So the Colorado will be the senior. And then maybe if they invest in Florida real estate, the Florida will be the junior. Not really necessary if you do multifamily, but still a possibility. So is your self-directed IRA structured where a fee charged per transaction or one-time yearly fee? So we're really big on flat fee pricing, Sean. Our accounts start at $360 and $15 a month. If our customers have 1 or 2 investments in there, or they have 100 investments, they're still paying $15 a month. Now, what we've been working on very heavily is if customers do not have an LLC, a lot of our customers in California really look for one because that tax is pretty heavy. We've had to charge some per investment fees for an LLC, an IRA with no LLC in it, because there's a lot of manual work with the custodian. What we're launching on October 25th, we're looking to bring that no LLC IRA to a much more flat fee pricing type model. So there'll be some exciting developments on that coming out in the next few weeks. We've brought that to the IRA LLC. A lot of people still dealing with direct custody deal with all these fee sheets so long. So we're trying to bring that to all types of IRAs. Okay, sorry, Josh, they're just rolling in here.
You should get Dan.
Yeah. So what does a monthly Rocket Dollar fee cover? That covers the opening of the continued service of the IRA. That covers any rollovers that are no fee. That covers pretty much as many investments as you want to do. The only thing it generally does not cover is a wire fee of $25. So a wire is the most old school way to send money to another institution, to get it to Josh as quickly as possible. He's like, money tomorrow, money Monday. Wire's probably going to be your best bet. You'll take a little hit, $25, but you're assured it's going to get there because there's actual bank employees working with the Federal Reserve to make sure Josh's bank, whoever he's using for the syndication, gets that money. So the $15 a month, we have no assets under management fee. We have no per investment fees. You can name them. A lot of other custodians have them. We try and really make the flat fee model pricing work, so it's really expected. You can always call afterwards or email us and look through our pricing and our knowledge base. All right. But to get in touch with our sales team, I would say info@rocketdollar is the best one. We're adding another salesperson next week. Chris and I have been very busy. We also have Tristan, who's joined our sales and marketing team. He's the younger guy. He's going to be getting on the phones too. We've just been very busy. So we're hiring at Rocket Dollar. We're actually going to be up to, we're over 20 employees now. We're on our way up and up. People are coming on in sales. You can also schedule a call right in there. And that's so that we don't miss each other. Chris and I are answering calls as much as we can, but a few missed calls came in today while we're on this webinar that I'll have to get to. And I just don't like to play phone tag with people because I know they probably hate it. And I want to make sure it's easy for them. So come into info@Rocket Dollar and then ask to schedule a call along with your questions. Anand asked, do you accept assets from another custodian and re-register the asset with Rocket Dollar? Currently, we do not. That is called an in-kind transfer. So that means if you worked with a competitor of ours, you had already worked with Josh's investment, and you said, hey, I want to bring Josh's investment from the IRA competitor and bring it over to Rocket Dollar all in one go. Currently, we don't support that. It is unfortunately really manual, really complex, and really hard to do. It's really hard to help technology to help our support team to make that move faster. We are working on that though. It will be expensive to do, but we are looking to bring that back sometime in the next year. I just don't have a firm date of when that is. So we get a lot of questions about it. We are working on it, but it will be a long work in progress to try and start supporting that and make it easier to do.
Let me just quickly cover Dan's question on accumulated depreciation.
Sure.
So you don't get separately taxed on the accumulated depreciation. It just, it drops the original basis. So if you bought something for $100,000, you have $50,000 of depreciation. Your new basis is 50, and then you get taxed on. Let's say you sell it for 200, you get taxed on 150,000. So it's all part of that UBIT calculation in the end.
Okay. Sorry, there was Don going on in the other. Sorry, Dan. There was a Don asking questions on the other side. I was just trying to rapid fire through all these. All right, breath. So I'm not going to take out my slides. We've had a really good talk today, but October 25th, you're going to see a lot of exciting new updates at Rocket Dollar. Our dev team has grown massively. We just talked to some new employees today that have come on in the last few weeks. A lot of exciting upgrades coming in, and that new direct custody IRA is going to be launching. And that's going to be for someone that maybe is not the most comfortable with alternative investing, doesn't is trying to figure it out, but they get really excited about the opportunity and learning about it. This is going to be a way for that person who's newer to the idea to get in and get quickly into something like one of Josh's multifamily deals. My custodian is merging with another big custodian. So typically, that custodian is going to accept your asset. We'll only accept cash at this moment. There are some potential workarounds, but it's really difficult at the moment to move from one custodian to another unless it's in cash. Stay tuned. I think late Q4, early next year. It's not going to be ready yet, but we're going to have some progress and ideas of how to get that done. All right, one for Josh. The UBIT calculation tax, does that impact annual or only at the sale of the related property?
So if you had UBIT to pay, it would happen annually. What we found is usually there's just losses for the first few years of a multifamily syndication. So it is wise to file so that you can use those losses and carry them forward. But ultimately, you only have to pay out of the gains when the property sells.
So yeah, if you got in a conversation with Josh, I think he can work with you on the UBIT calculator.
Yeah, so the UBIT calculator is a tricky one. I'm still trying to figure out how to make it more user-friendly. It requires, I think, 58 variables. So it's mostly information that limited partners don't ultimately end up having. So I haven't pushed it out to the masses or anything, unfortunately, but I can run through past versions and results. Yeah,
and Josh would be happy to help. Just know it's Josh's time. He's got to do some significant amount of work on that, and it's a great tool. It's just with the complexity of UBIT, you want to make sure that you're obviously giving people correct information and they're not messing up some input before that really goes out to the general public. Yeah, because with the 58 variables, you just it's It's generally, when you start an investment, it's good to have a general idea of UBIT. You're not going to have it down to the dollar probably, but it's good to know going in, okay, what's a general impact of UBIT? And then when you get at the end of the first year, you're getting a much more, seems like year 1, 2, 3, those years really start to show you, Josh, what the UBIT impact actually is.
Yeah, exactly.
Okay. All right. All right, I'm gonna have to get back to my day. So last call for questions, everyone. If it is not a leverage investment like private equity, then there's no UBIT, correct? So there are 8 types of UBIT. UDFI, unrealized debt finance income, is the very common one that hits real estate investors. So real estate investors have like one boogeyman that always comes after them. And like I said, Josh helps prepare people so they're prepared for UBIT. I say be prepared for UBIT, don't be scared of UBIT. Our solo 401k helps get rid of that UDFI. So we didn't mention this too much on the call. Sometimes solo 401k investors, if you are self-employed, can get a great, even higher return because they are wiping UBIT, that UDFI, off the map. However, it does not stop every type of UBIT. UBIT was created so you couldn't hide a business inside of a charity or a retirement account. So there are other potential places, like if you just shove a business in an IRA, that you could be hit with different types of UBIT. That's the high level CPA requirement. Someone asked about cannabis fund investments. Right now we cannot, but October 25th, we're getting a lot more flexibility on that. So in just 2 short weeks, we are getting some more flexibility on cannabis investments. Okay, Josh, I'm going to call it. I'm been on a roll here. Thanks so much for coming today. We're going to get this up on YouTube just about an hour. It's going to be in our webinar archives probably later this week. Thank you everyone for coming so much, and any closing words, Josh?
No, thanks for having me. Appreciate you all coming out.
All right. Thanks so much, everyone. Oh, you're the host, so please end it and end my record.
Thanks.